For decades, the global economy ran on an assumption that Japan would always be there, quietly buying, quietly funding, quietly stabilizing a system built on debt. But this morning, that assumption broke. No headlines, no emergency sirens. Just a subtle shift in yields, in flows, in silence. And yet, behind that silence, the largest creditor on earth may have just pulled away from the table. If Japan stops funding the world, who replaces them? If the cheapest money source in history dries up, what happens to stocks, to bonds, to currencies, to your capital? This is not a crash story. This is a structural unwind. And once it starts, it doesn't stop. It spreads. The question is not if the shock reaches you. The question is when, and whether you will recognize it before everyone else does. Welcome to Boring Currency Ledger. If you value calm analysis over noise, if you believe experience matters more than excitement, then consider subscribing, not quickly, but carefully, the way someone who has lived through cycles chooses protection, not promises. And before we begin, tell us in the comments, from where in the world are you watching this unfold? Let's begin. For many years, Japan appeared quiet in the global economy. It did not grow fast. It did not dominate headlines. It did not lead innovation cycles the way other major economies did. Because of this, many investors assumed Japan no longer mattered. That assumption was wrong. Japan was never loud. It was structural. For more than 30 years, Japan played a role that few people truly understood. After its asset bubble collapsed in the early 1990s, Japan entered a long period of low growth and near zero interest rates. Instead of allowing markets to reset naturally, Japanese authorities chose stability at all costs. Interest rates were pushed down. Bond yields were held in place. Cheap money became permanent. This decision shaped the global economy. Capital inside Japan earned almost nothing at home. Savings could not grow. Institutions responsible for pensions and insurance payouts could not meet long-term obligations by staying domestic, so they looked outward. Japanese money flowed into foreign bonds, foreign stocks, and foreign governments. Quietly and consistently, Japan became the world's largest creditor, not through dominance, but through necessity. This is why Japan mattered. When money was cheap in Japan, money was cheap everywhere. Global markets expanded because Japan supplied steady capital. Risk increased, leverage increased, asset prices rose. Entire business models formed around the assumption that this flow would never end. But this system depended on one fragile condition: Japanese interest rates staying near zero. That condition has now broken. Japanese government bond yields have begun to rise sharply. To some observers, these numbers appear modest. In other countries, such yields would not cause alarm. But Japan does not operate like other countries. Its economy, its debt, and its institutions were built on zero rates. When yields rise in Japan, the system does not adjust slowly. It destabilizes quickly. Japan carries one of the highest debt levels in the developed world. Servicing that debt was only possible because borrowing costs were near zero. As yields rise, interest expenses increase rapidly. What once looked manageable becomes dangerous. This is why the shift matters. For decades, the Bank of Japan acted as a permanent buyer of government bonds. Markets stopped functioning normally. Prices stopped reflecting risk. Yield signals were suppressed. Stability replaced truth. This artificial calm did not stay contained. It spilled into global markets. Cheap Japanese money fueled carry trades. Investors borrowed yen at almost no cost and invested it elsewhere. Stocks, real estate, and speculative assets all benefited. When Japanese rates rise, this foundation cracks. Authorities now face a choice they avoided for decades. They can protect the bond market or defend the currency. They cannot do both. They have chosen to defend the currency. That choice changes global capital flows. As Japan steps back from controlling yields, capital behavior shifts. Money that once left Japan begins to return. This is not emotional. It is mechanical. Higher yields pull capital home. Risk exposure is reduced. Balance sheets are repaired. Global markets were built on the assumption that Japan would always be present as a buyer. That assumption is no longer valid. Japan is not collapsing. Japan is recalibrating. And that recalibration is pulling the global financial system with it. What looks like a technical move in yields is, in reality, the end of a 30-year financial structure. The rules that governed capital, risk, and stability are changing. Japan was the quiet support beneath the system. And that support has just been removed. For decades, global markets followed a simple but invisible rule. Money flowed from Japan to the rest of the world. It was steady, it was predictable, and most importantly, it was taken for granted. Very few people asked why this money moved. They only cared that it did. Japan became the world's quiet banker because it had no choice. At home, returns were near zero. Bonds paid almost nothing. Savings earned nothing. For Japanese institutions responsible for pensions, insurance payouts, and long-term liabilities, staying domestic meant falling behind. So they looked outward. They bought U.S. government bonds. They bought European debt. They bought American stocks. They bought anything that offered yield. This outward flow shaped the modern financial world. It helped push stock markets higher. It helped governments borrow cheaply. It helped companies expand using low-cost capital. Entire business strategies were built on the assumption that global money would always be available and always be cheap. But capital does not move out of loyalty. It moves for math. And the math has changed. As Japanese bond yields rise, the reason to send money abroad disappears. Why accept currency risk? Why accept volatility? Why accept foreign political uncertainty when similar or better returns now exist at home? This is where the reversal begins. When yields rise in Japan, capital is pulled back like a tide changing direction. This process is called repatriation. But this is not a voluntary decision made during calm conditions. It is driven by pressure. Japanese institutions hold massive bond portfolios. When yields rise, the value of those bonds falls. This creates losses on balance sheets. For pension funds and insurers, losses are not theoretical. They threaten solvency. To repair these balance sheets, cash is required. And cash comes from selling what is liquid and profitable. That is the key point many miss. Japanese institutions are not selling because they want to exit global markets. They are selling because they must. Their safest assets are under stress. To stabilize themselves, they must liquidate their strongest positions. Those positions are foreign. This is why the selling pressure matters so much. It is not emotional. It is not panic-driven. It is mandated. It is structural. When selling is forced, price becomes secondary. This creates what can be described as a global margin call. Not one dramatic event, but a slow, persistent drain. Assets are sold not all at once, but methodically, day after day, month after month. This is more dangerous than a sudden crash. In a crash, fear peaks quickly. Prices fall hard. Buyers step in. The system resets. But in a slow liquidation, hope remains alive. Rallies appear. Optimism returns briefly, and each rally is used as an exit. Markets are quietly capped. And because Japan operates at massive scale, even a partial reversal has global consequences. When one of the largest exporters of capital becomes a net absorber, the entire system must adjust. The adjustment is not smooth. Markets built on constant inflows now face constant outflows. Prices must fall until new buyers appear. But those buyers are scarce. Many are already leveraged. Many are already exposed. Many are waiting for central banks to intervene. This is why the repatriation event is so powerful. It removes the quiet support that held markets together. It exposes how dependent global assets became on a single source of cheap funding. For years, Japan was invisible because it was stable. Now it is visible because it is changing. This is the great reversal. Money that once searched the world for return is now searching for safety at home. And when money goes home, it does not ask permission from global markets. It simply leaves. The result is a slow tightening of financial conditions everywhere else. This is not a collapse yet, but it is a squeeze. And once liquidity begins to contract, the system reveals its weakest points. At first, nothing appears broken. Prices still move. Headlines still talk about growth. Analysts still debate earnings and forecasts. To the casual observer, the system looks intact, but underneath the surface, something essential has changed. The floor is gone. For decades, global markets operated with an invisible support. Whenever stress appeared, liquidity arrived. Whenever prices dipped, buyers emerged. This created confidence. Investors learned that risk was temporary and recovery was reliable. That confidence was built on flow, not fundamentals. Japan was a major part of that flow. When Japanese institutions were steady buyers of global assets, markets had depth. Selling pressure could be absorbed. Even large shocks eventually stabilized because capital was always available somewhere. Now that balance is shifting. As Japan steps back, markets are forced to operate without their largest passive buyer. This does not cause an immediate collapse. Instead, it creates a cascade, slow, quiet, and uneven. The first effect appears in equity markets. Stocks do not crash outright. They struggle. Rallies become weaker. Recoveries fail sooner. Every rise meets resistance. This is not because companies suddenly stopped operating, but because capital is being withdrawn faster than it is replaced. When institutional selling is constant, price discovery changes. Markets stop responding to good news. Earnings beats no longer lift valuations. Optimism loses power. This is how a distribution phase begins. Stocks are passed from large institutions to smaller investors. The selling is patient. It waits for volume. It uses strength to exit. Over time, this creates lower highs and lower lows. This environment is especially dangerous for investors trained to buy dips. That strategy worked when liquidity was expanding. It fails when liquidity is contracting. The second effect hits bond markets. As Japan reduces its role as a global bond buyer, yields rise elsewhere. Prices fall. What was once considered safe becomes volatile. Duration risk, long ignored, reappears. This creates a problem for portfolios designed around diversification. Stocks and bonds begin to fall together. The historical relationship breaks down. This is not a market anomaly. It is a mathematical outcome. When a system deleverages, correlations rise. Everything is sold to raise cash. The idea of safety through balance collapses when the same force is pulling on every asset. The third effect unfolds in currency markets. As Japanese capital returns home, the yen strengthens. Other currencies weaken. This adds stress to countries and companies that borrowed in foreign currency. Debt becomes more expensive. Refinancing becomes harder. Currency moves amplify financial pressure, and what begins as a bond issue becomes an economic issue. At this stage, leverage becomes the enemy. Strategies that relied on low volatility and cheap funding begin to fail. Hedge funds reduce exposure, banks tighten conditions, credit becomes selective, margins rise. None of this happens overnight. This is why the cascade is dangerous. There is no single moment of panic. Instead, confidence erodes slowly. Investors become cautious. Liquidity thins. Bid-ask spreads widen. Markets become fragile. Small shocks create large reactions. This is how systems fail, not through explosions, but through exhaustion. Another critical change occurs in market psychology. When recoveries fail repeatedly, trust breaks. Participants stop believing in rebounds. Risk appetite fades. This is when volatility increases even without headlines. Markets begin to move on absence rather than presence. The absence of buyers, the absence of support, the absence of certainty. The removal of Japan as a stabilizing force exposes how dependent the system became on artificial calm. Without constant inflows, valuations must reset to levels justified by real demand. That reset is rarely gentle. The most vulnerable assets are those priced for perfection. High valuations require continuous belief. When belief fades, price follows. This cascade does not discriminate. It affects stocks, bonds, and speculative assets alike. Anything dependent on leverage or constant inflows becomes fragile. What makes this phase especially challenging is that it confuses participants. Traditional signals stop working. Good news fails to lift prices. Bad news accelerates declines. This is not because markets are irrational, it is because they are repricing risk. The global system is learning to operate without its quiet sponsor. And when support disappears, the true weight of the structure becomes visible. This is the silent cascade. It does not announce itself. It unfolds. And by the time it is recognized, positioning has already become difficult. The cascade is not the end. It is the transition. And transitions are where most capital is lost. As global markets adjust to Japan's retreat, attention slowly shifts to the institutions designed to prevent disorder. Central banks were created to smooth cycles, provide liquidity, and maintain confidence. But in moments of structural stress, their choices narrow. They do not control outcomes. They choose which consequences to accept. The withdrawal of Japan as a major global buyer creates a vacuum. Government debt still needs buyers. Financial systems still need liquidity. Markets still need a backstop. But private capital, constrained by risk and balance sheets, cannot fill the gap at scale. This is where central banks are pulled into the center of the crisis. The Federal Reserve sits at the core of the global financial system. The US dollar remains the primary reserve currency. US Treasury bonds remain the foundation of global collateral. When stress reaches this level, inaction is not neutral. If large foreign holders reduce purchases or begin selling, yields rise. Rising yields increase borrowing costs. Higher borrowing costs slow economies, strain governments, and expose weak institutions. Left unchecked, this becomes self-reinforcing. The problem is scale. Modern governments operate with high debt levels. They roll over obligations continuously. They depend on stable interest rates. Even modest increases in yields can overwhelm budgets. When market forces push yields higher, central banks face a dilemma: allow rates to rise and accept economic contraction, or intervene and absorb the pressure. History shows which path is usually chosen. Intervention. Central banks step in as buyers of last resort. They create money to purchase bonds. They stabilize markets by replacing private demand with public balance sheets. This process has a technical name: debt monetization. It is often framed as temporary or targeted, but the mechanism is consistent. Money is created, assets are absorbed, yields are suppressed. In the short term, this works. Markets calm. Liquidity returns. Crisis is delayed, but the cost is currency integrity. When money is created faster than economic output, purchasing power erodes. The system trades solvency for stability. Inflation becomes the release valve. This is the central bank trap. They cannot allow disorder. They cannot allow collapse. But by preventing it, they undermine the value of the currency they issue. Japan's shift accelerates this trap globally. As one of the largest foreign creditors reduces its role, pressure concentrates elsewhere. The burden of support falls increasingly on domestic central banks. Balance sheets expand, policy flexibility shrinks. This is not a failure of policy, it is a limitation of arithmetic. At this stage, asset prices begin to reflect the change. Not all assets respond equally. Financial assets tied to cash flows struggle. Real assets with limited supply respond differently. Investors who recognize this shift early adjust positioning. They reduce exposure to long-duration risk. They prioritize assets with minimal counterparty exposure. This is not speculation. It is risk management. The key insight is timing. Central bank intervention does not happen at the start of stress. It happens after pressure builds, after markets test limits, after confidence weakens. By the time policy responses are visible, the structural change is already underway. Japan's decision to step back forces the system to reveal its dependencies. It shows where support truly comes from, and it clarifies the cost of maintaining stability. This is why the event matters beyond markets. It affects how capital is valued, how risk is priced, how trust is measured. The era of effortless stability is ending, not because of policy mistakes, but because the structure that supported it is no longer viable. Central banks will act, they always do, but their actions will not restore the old system. They will manage the transition to a new one. For decision makers, the lesson is not to predict exact outcomes, but to understand direction. Liquidity will be provided, currencies will absorb the cost, capital will move toward what cannot be diluted. This is the final stage of the warning. Japan did not cause the problem, it exposed it, and once exposed, the system cannot return to ignorance. The plug has been pulled. What remains is adjustment.